Welcome, friends, in this series of financial jargons simplifying financial jargons. Today we will discuss about monetary policy. It is announced by RBI. Actually, there is RBI Act of 1934. As per that, RBI is mandated with to announce RBI this announce monetary policy. Let us see what is the definition of monetary policy, then we will dissect further. Monetary policy is a set of tools used by nation's central bank, here Reserve Bank of India, to control the overall money supply and promote economic growth and employ strategies such as receiving, revising interest rates and changing bank reserve requirements. So, as per this definition, there are certain mandates which is required to fulfill by a RBI. The main aim of this policy is to stabilize price so that economic growth can be sustainable in a sustained manner. So, main objective of monetary policy is maintain price stability while keeping in mind the objective of growth. Of course, they have to control inflation. How this price stability can be maintained by controlling inflation. In India, RBI has been mandated to control inflation 4% plus minus 2%. That means downside it can be 2% and maximum 6%. So in between it is okay for RBI. So what are the functions? First function by definition we understand price stabilization, control of inflation and boost economic growth. Another function is fixed rate of interest, reserve ratio, foreign currency exchange rate. So these are the functions and tools. Of course, additional function is buy and sell of government bonds by RBI. So how this achieved? What are the tools? Of course, RBI have different tools. Main tools are three or four tools. First is open market operation. By open market operation, RBI controls supply of money in country, in economy. So how it is controlled? By buying government bonds or selling government bonds to investors. From investor either RBI can buy or sell, by which the liquidity situation is maintained as per requirement. If inflation is more, then RBI would like to control supply of money. So in that case, they will sell more government bonds and money will be deposited to RBI. If RBI want to have more liquidity, supply of money in the system, then it will buy bonds from market from open market. In this way, this money supply can be controlled or regulated as per requirement, can be increased or decreased. Second tool with RBI is interest rates. By this change of interest rate, also supply of money in the system is achieved. If there is more inflation, RBI will increase slowly this interest rate. As interest rate will increase, people will buy less, consume less, and there will be less credit growth. People will take or corporation will take less loan, and then people will consume less, and then this inflation will come down. Another way is to change reserve requirements. As per RBI guidelines and policy announcement, every bank have to maintain SLR, statutory liquidity ratio, and CRR. By this also, RBI controls supply of money in the system. If these reserve requirements increased, then bank will have less money to lend. Then of course there will be less money available in the system, and as less money available in the system, there will be less activity, less consumption, and inflation will go down. Of course, it will affect economic growth also. So these are the tools with RBI. So what are the goals? There are main three goals. First is inflation, control of inflation. As I told earlier, the RBI is mandated with to control or regulate inflation at 4% plus minus 2%. So first goal is inflation, control of inflation. Second is unemployment control. By economic growth, by increasing supply of money in the system, economic activity will increase and unemployment will be reduced. So this is also a goal of RBI. And third goal is exchange rate. RBI try to fix exchange rate in such a way so that import and export can be regulated, cannot be in such a way that export is hampered due to unfavorable exchange rate. So these are the goals. Now there are two types of monetary policy. First is expansionary, second is contractionary. When there is less activity or recession or bad situation in economy, at that time RBI brings monetary policy in such a way so that they can create more employment, more job, more economic activity. So in that situation, this monetary policy is known as expansionary, which expands, which creates more economic growth. When inflation is more, RBI is required to regulate or curb the inflation. For that purposes, RBI required to squeeze the money supply in the system. As money supply is squeezed, consumption activity will be squeezed, and such monetary policy is known as contractionary because it contracts the overall activity in the system. Now, who is responsible within RBI? There is MPC, Monetary Policy Committee, and six people is member of that committee who meets regularly, discusses, and then announces this. Of course, this RBI governor is chairperson of this MPC committee or Monetary Policy Committee. Right now, Mr. Shaktikant Das is RBI governor and he is chairperson of this MPC committee. In charge of MPC committee is Dr. Michael Devabrat Patra at present. So he is responsible for this monetary policy. Normally, four times required this monetary policy to be announced in each quarter. But as requirement increases, RBI sits bi-monthly also and announces monetary policy. If required more, as and when required, to require RBI sees there is a requirement of policy changes, then of course MPC committee sits, dwells, and then brings necessary changes, announces changes in monetary policy. So it is not fixed four times only they can sit. Of course, in the beginning of the year, they try to set a policy for whole year. But as the dynamic condition, not only inside the country, worldwide, there is so many activity going on, so many changes happens. So only thing is stable is they have to look into these policies and revise policy to suit economic condition, inflation of country. So in the beginning, it was supposed for 1 year, but then every quarter, and as requirements increases by monthly or as and when it is requirement, RBI sits and announces monetary policy. Now you would have fair amount of idea what is monetary policy and how it happens. Now you may question what is fiscal policy, how it is different. Monetary policy is under RBI, Reserve Bank of India, or any country's national the central bank. But fiscal policy is the domain of government, any government of that very country. And through fiscal policy, government brings changes in expenditure, revenue, and overall activity of economic in any country. Of course, both works in tandem in consultation with each other and try to control overall situation with monetary policy and fiscal policy of any country. If you find value in this conversation, please do like it and share with your friends and colleagues so that they can also get benefit of this. Please do subscribe to this channel if not subscribed so far. Thanking you.